Welcome back to Stock School Daily.
Plan is to launch a product called Beast Mobile.
Beast Mobile. When I hear that, I assume it's like a phone plan, like
Yeah.
Ryan Reynolds and Mint Mobile.
You would think so, right? But the research note suggests something much, much more ambitious. This is going to be a DeFi integrated financial services platform.
Whoa, hold on. A financial platform. So they aren't selling phone data. They're building a bank.
Effectively, yes. The idea is to take BitMine's Maven technology, that complex staking plumbing we just talked about, and wrapped it in the super user-friendly, highly trusted Beast branding.
So if I'm understanding this correctly,
Yeah.
they aren't trying to teach 450 million people how to set up a MetaMask wallet and manage seed phrases.
No, not at all.
They're building an app that just looks like a normal banking app, but the engine is crypto.
That is the implication. The user just sees deposit money, earn 5% APY. They trust MrBeast, so they do it. But on the back end, BitMine is running the Maven tech to generate that yield using Ethereum staking.
That is bold.
It's incredibly bold. But think about the business model innovation here. This is the part that really excites the analysts. It's all about CAC.
Customer acquisition costs.
Right. If you and I wanted to start a neobank today, let's call it Deep Dive Bank, what is our single biggest expense?
Marketing. We'd have to buy ads on Instagram. We'd have to pay for Google search terms, maybe a Super Bowl ad if we got ambitious. You have to pay to get people to download the app.
Exactly. In the fintech world, acquiring a funded customer, someone who actually puts money in, can cost anywhere from $50 to $200 per person. It is brutally expensive.
Which is why so many of them fail.
Right. They burn through all their venture capital just buying users, and they run out of cash before they ever turn a profit.
I see where you're going with this. Beast Industries doesn't have to buy ads.
MrBeast is the ad. He turns on the camera, holds up the phone, and says, "Download this app to manage your money." He has zero marginal cost of distribution to 450 million people.
That's the Beast effect. It's an arbitrage on customer acquisition. BitMine provides the financial rails, and Beast provides the free users.
It's an unfair advantage. If they convert just 1% of his audience, just 1%, that is 4.5 million active users on day one.
Wow.
A traditional bank or a fintech company would have to spend $500 million in marketing to get that many users.
And BitMine gets its revenue from the technical consulting and the transaction fees from all that volume.
Exactly. They move from just mining ETH to taking a skim off millions of financial transactions. That is a much, much better business model. It's recurring revenue. It's sticky.
It sounds incredible on paper. I mean, eliminating the biggest cost in banking customer acquisition is kind of the holy grail. But as investors, or just as critical thinkers, we have to look at the price tag. You mentioned a $47 price target from B. Riley. How do they actually get to that number? Is it just wishful thinking?
This brings us to the valuation analysis, and honestly, this is the strongest part of the whole argument. To understand that $47 target, we need to talk about a financial metric called MNAV.
MNAV, Market Net Asset Value. Okay,
Yeah.
break that down for us. Assume I left my CFA designation in my other pants.
It's actually quite simple. MNAV is basically the liquidation value of the company.
Liquidation value.
If BitMine shut down today, sold all their mining rigs on eBay, sold all the Ethereum they're holding on Coinbase, and paid off all their debts, MNAV is the pile of cash that's left over.
Okay, so it's the floor. It's the value of the stuff they actually own right now.
Correct. And currently, BMNR is trading at approximately 1.0x MNAV.
1 times.
Yeah.
So the stock price essentially just equals the value of the stuff they already have in the bank.
Exactly. The market is pricing the stock strictly on its current assets, the crypto they hold, the mining rigs, the cash.
So wait a minute. If the stock price is just reflecting the stuff they already own, then what are we paying for the MrBeast deal? What are we paying for this potential fintech revolution?
That's the catch. According to the valuation, you're paying zero.
Nothing.
Nothing.
Yeah.
The market is effectively giving investors the potential growth from the MrBeast partnership for free.
That is wild. It's like buying a house for the cost of the bricks in the land.
Yeah.
And the seller just throws in a winning lottery ticket on the kitchen counter for free.
That is a perfect analogy. The analyst's view is that the market hasn't priced in the deal yet. Investors look at BMNR and they still see a boring crypto miner. They don't see the consumer fintech play yet.
I see.
Shopalin believes this partnership justifies a premium valuation.
Meaning you shouldn't value a high-growth fintech company the same way you value a passive holding company.
Exactly. Growth companies trade at multiples of their revenue or assets. Boring holding companies trade at the value of their assets. That $47 target is based on the idea that the market will eventually wake up and realize, oh, this isn't just a pile of Ethereum anymore. This is a growth engine.
And that gap between the boring miner valuation and the exciting fintech valuation is where that 52% upside comes from.
Precisely. It's a repricing event.
Okay, I'm feeling the hype. I am. The logic holds up. The math on the customer acquisition cost is undeniable. But
Yeah.
this is the deep dive, not the fan club.
Right.
We have to look at the other side of the ledger.
The risks.
The risks. Because pivoting from running servers in a cold room to managing money for millions of people, that is not a small step. That is a canyon.
It's a minefield. And to their credit, the B. Riley report is very clear about the risks. You can't pivot a company like this without hitting some turbulence.
So what's the biggest red flag here? What keeps you up at night with a deal like this?
The first one is obvious. Regulation.
Oh, yeah. The moment you say DeFi and consumer finance in the same sentence, you know the regulator's ears perk up.
It is the elephant in the room. Launching a financial platform is hard enough. Launching one that involves crypto or decentralized finance elements invites significant scrutiny. The SEC, banking regulators, they are all going to want to know exactly how Beast Mobile works.
Right. I mean, if Beast Mobile promises a 5% yield based on staking, isn't there a risk the SEC looks at that and just says, that's an unregistered security?
That is the billion-dollar question. We've seen the SEC go after other crypto yield products aggressively. If they decide Beast Mobile falls under that umbrella, they could shut the whole thing down.
Or just tie up in court for years.
For years. And think about MrBeast's brand. It's family-friendly, it's high energy, it's philanthropy, it's fun. Being investigated by the SEC for securities violations doesn't exactly fit that vibe.
No. That brings up reputational risk. If there's a hack which happens in DeFi all the time, or if the yield drops and people lose money, the backlash won't be against BitMine. Nobody knows who BitMine is.
No, the backlash will be against MrBeast.
And he has a lot more to lose than they do. His entire empire is built on trust.
Exactly. So you have to assume the compliance guardrails on this app are going to be incredibly tight, which might make the product less cool or profitable than the BFidations hope.
They might have to water it down so much to please the regulators that it loses its edge.
That's a huge risk.
And speaking of the product, does it actually exist yet?
That's risk number 3.
Yeah.
Execution. The report notes that the execution and launch of Beast Mobile is upcoming.
Upcoming. That's corporate speak for it that doesn't exist yet.
Effectively, yes.
Right.
We're betting on a vision right now. And BitMine is an infrastructure company. They're good at hardware. Building a consumer-facing app with banking-grade security, dealing with customer support for millions of people, making sure the app doesn't crash when a video goes viral, that requires a totally different DNA.
It's one thing to make a YouTube video. It's a whole other thing to build a banking app that handles millions of people's life savings. Software development is hard.
It is, and we've seen plenty of strategic partnerships in the past that ended up being nothing more than a press release. The risk here is that they spend the $200 million and simply fail to capture the audience. Maybe the fans just want to watch the videos and don't want to bank with the brand.
If you found this helpful, hit that like button and subscribe for more.